All right, y'all. I'm super excited to be going over this session with you today because what we are going to do is take everything that we've learned about order flow, about delta, about CVD, about open interest, and we're going to be discussing how to enter trades on a trend reversal chart. Now, this will allow you to scalp very small moves with very high accuracy, and this will also allow you to enter into longer term day trades or even swing trades with very high accuracy. And so first we're going to discuss what exactly is a trend reversal chart. Okay, what is a trend reversal chart, also called a TR chart? When we first started learning about time frames in exocharts, we also learned that there are different types of charts that we can view. For example, usually candlesticks are based on time frames. However, in exocharts, we can look at a chart that is based on volume. We can see right here that this chart right here is based on 1 million volume in general, right? Sometimes a little bit more, sometimes a little bit less, but in general, each candlestick prints when there has been 1 million contracts exchanged hands back and forth, right? We can also view charts based on range, okay? Range is essentially, this is a little bit confusing, but when we're looking at a range chart on exocharts, it's going to be based on tick. And when we're looking at tick charts, it's basically going to be based on how many transactions occurred within that candle. But we also have these charts over here called trend rev charts. And these are actually based on tick and transactions that happen for a candle to print. And we can use these types of charts to spot reversals on very low time frames. And when we combine that with CVD divergences, or even just looking at trapped traders, or even combining it with key levels of support or resistance, we can get into some very juicy trades. And so I want to go over just some basic strategies today. And then later on, as the course progresses, me and Blaine are going to be uploading more and more material, going over more and more strategies that you can use with this type of chart. So the template is available for you to import in the course materials, as well as if you are in the VIP Discord, you can view this template as well. Now, just to quickly go over how you would get this if you were just, let's say, starting from an order flow chart, you would come over to the time frame, go to trend rev 4426, make sure the tick is set to 1, make sure the delta clusters are void, make sure the text is none. I like to use the flat candles, make sure the POC is turned off. And I like to keep on the marker levels because I want to know where all these levels are. I like to keep on the VWAP. I like to use open interest. I like to use CVD. And then I like to use my footprint bar statistics to view the CVD, the volume, and the delta. And for my specific template here, I like to split the CVD into two. I like to see it in the actual number. I'm sorry, the delta, not the CVD. I like to split the delta into two. I like to view delta as the actual number, as well as delta in a percentage, because looking at delta as a percentage can really help you know when certain players in the market are running out of steam and we can expect a reversal. So the most basic strategy for trading the trend reversal chart in a nutshell is simply looking for a wick and then looking for a CVD absorption divergence. Okay, now it's very important that we understand these wicks here. These wicks represent potential reversal candles. Now, there's a few things I need to note about these wicks. If you are using the desktop version of exocharts, you have nothing to worry about. However, if you are using the browser version, there are glitches that print on these candles. Just so you are aware, the blue candles can only print downward wicks, and the purple candles can only print upward wicks. If you see anything other than that, it is a bug. So blue candles should only be printing down-facing wicks. If you see a blue candle printing an upward-facing wick, that is a bug, and you need to ignore it on the browser version. For the purple candles, okay, purple candles can only wick to the upside. If you see, for example, a purple candle wicking to the downside, like this one right here, this is a glitch candle. Do not consider that to be an actual reversal candle. This one right here, this is a glitch. Do not consider this to be a reversal candle. we should only be looking for blue candles to wick to the downside, signifying a reversal, and purple candles to wick to the upside, signifying a reversal. Anything else is a glitch on the browser version. So the basic strategy for this is we are going to be looking for absorption CVD divergences with a candle that has a wick. So let's come over here and let's go over to our handy dandy whiteboard, and let me just kind of show you what we are going to be looking for. Okay, let's say that we are looking at the TR chart in an uptrend, right? And it's making higher highs, higher highs. Now all of a sudden we see a lower high, okay? And this lower high is giving us a wick to the upside. This is signifying to us that potentially there's going to be a reversal there. If we see that the CVD is getting higher as time goes on, it's getting higher, it's getting higher, it's getting higher. And we can clearly see that although we have a lower high and a wick to the upside, but CVD is making a higher high, this is a divergence, and this signifies that we should enter into a trade. This is the basic strategy. It's the same thing that we were doing for the order flow using CVD divergence, absorption divergences. However, this is now on a trend reversal chart. So again, these candles are not based on time. They are based on tick and transactions that occur. And so it's giving us very, very high accuracy with the CVD. So for example, earlier this morning, there was a really nice short trade that we could have taken right here, because as we can see, we have a lower high, and on this lower high, we have a wick to the upside on a purple candle, and we have the CVD getting higher. And from this point, we have a very significant move to the downside. Okay. Again, earlier today, we also had many other trades. I'm just going to go over the basic strategy because there are ways to trade with this chart without looking for the absorption divergence, but that is the simplest. So check out this right here. We have down here very, very clearly the price making a higher low with a blue candle wicking to the downside right here. And we can clearly see CVD making a lower low. So price is making a higher low, CVD is making a lower low. Look what happens. We enter the trade, boom, we get a pretty significant pump. And I'm talking like, you know, these are usually smaller moves, but if we actually like zoom out and see what happened here, that entry could have gotten us into this massive trade to the upside, right? It could have gotten us into a massive trade to the upside. And we're just looking at precision. It's like X-ray vision right here to really see what is happening. All right. Again, look at this. We are making a lower high, but the CVD is making a higher high as the purple candle is wicking to the upside. And boom, we drop. Now, these types of trades happen, I would say, anywhere between 5 and 15 times per day. In fact, the past few days, I've literally just been scalping this type of strategy, and I've been taking anywhere between 3 and 7 trades a day, and I'm not doing this all day. I'm just doing it when I have free time, and it's been very, very, very lucrative for me. And so this is extremely, extremely juicy, okay? Now, that is the basic strategy. What I recommend you do in order to make sure that you're not falling for leading CVD is you wait for confirmation. And the way you wait for confirmation is once you see the candle printing the wick and it confirms and we move on to the next candle, you enter right there, you mark it in right here, you put your stop loss above that previous candle that wicked. So what this allows us to do is it allows us to use very high leverage, very tight stop loss, and they have very good risk to reward ratio. Extremely good risk to reward ratio, because we're really only, you know, if we're entering at this candle right here at 38878 and our stop loss goes above here, that's like a $20 stop loss, $30 if we want to give it a little extra room. But the thing is, we're expecting that because we're getting this lower high and the higher high in the CVD that we're going to be coming down here. Okay, these are very, very juicy trades. And they happen, honestly, pretty often, as I was saying before. So look at this right here again. This was not one. Hang on, I have to zoom in to read the CBD. Now, something else actually that you can do is not just be looking at the CBD line, but actually be looking at your CBD down here, because you'll be able to see as you zoom in the actual number on the CBD. So you can see, okay, we have negative 1.8 million, and then we can see that CBD is getting lower to negative 1.5 million. It's a little bit difficult to see on this chart here, but we can see clearly negative 1.8 million. And then we put in a higher low with negative 1.5 million, showing our CBD is getting higher right here. So this would not be considered a divergence. But if this CBD was lower in number, we would know, in fact, that it was a divergence. Let's see, did we have one right here? No, we did not have one there. Let's zoom out and see if we can find more. These types of trades happen quite often, like I said. And was this one here? Yeah, this was even one right here where we made the lower high and then we made the higher high on the CBD. Let me mute this tab here. And this is the basic strategy. So let's talk a little bit about take profits and stop losses. Okay, so for me, the way I've been doing this is essentially when I enter a trade like this, if we're not at a key level of support or resistance, then I mark it into the trade and then I set a limit take profit order after a $150 move. And when I hit that $150 move take profit, I will then take out 50% of the trade and move the stop loss to the entry. And then I will set take profit to limit order at a $300 move. Now, this is if I'm entering a scalp trade and I'm not expecting a big move to the upside or downside, because I just see a random CBD divergence and I'm looking to take a quick scalp. If we come to a key level, for example, the VWAP or the previous day high or the previous day value area high or a golden pocket, then you would actually be looking to hold the trades a little bit longer. So for example, earlier today, we came up to the, right here, we came up to the previous day value area high. Okay, the previous day value area high. And at the previous day value area high, we can see that we put in a lower high from here to here. And we can see that the CBD was getting higher, okay? So this would have been our short signal because we have the wick right here. We have the lower high from here to here. And then we would have entered our short right here at 39,108, set our stop loss above here, and then look at how long we could have stayed in the trade all the way down to this area. In fact, this was one of the exact shorts that I did take because of this CBD divergence here. But because it was the previous day value area high, I actually set my take profits a little bit more than $150. And for that, what I like to do is I'd like to use other key levels of support or resistance. So if you're taking a scalp without any key levels, I like to use $150 TP1, $300 TP2. But if you're actually taking the trade at a key level, then I like to use other key levels as my take profit. So in this case, take profit 1 was at the previous day point of control. Take profit 2 was down at the VWAP. Okay, so let's talk about other confluences. Okay, because this, what I just went over, is the basic strategy, but there are other confluences you can use in order to make this much juicier. For the best trades, look for key levels. Okay, look for key levels. Look for golden pockets. Look for previous day levels. Look for the VWAP. Look for daily levels, weekly levels. If you can identify a key level on your chart, then absolutely take that trade more seriously as if you were going to do more than a scalp, okay? Now, the second confluence you should be looking for is delta and volume. okay, delta and volume. For example, when we come to the VWAP earlier today for a bounce, okay, I was looking at the TR chart, and I actually did take a long right here from the VWAP. And as we come to the VWAP, I want you to notice something. We can see a huge spike in volume right here. A huge spike in volume, a huge spike in negative delta. And notice this, okay? Notice this. The reason why I have two deltas here, one is a number and one is a percentage, is because if you see a really high spike in volume and delta, and the sell delta is 100%, this is a sign that the sellers are getting exhausted. If the delta is negative 100%, it can't go any higher than 100%. And so if you see this negative delta here, and you see it's at 100%, and you see a huge spike in volume as we're coming to a key area of support, then you can wait and see if we have any trapped traders. Now, it's a little bit difficult to see this here, but if we take a look at the CVD line, we can see that as we come higher, it's very hard to see, but we can see that the CVD is actually getting lower, and it doesn't actually show here because of the fact that it's too small of a move to actually show. But we can see here, if we just look at the delta, that we have positive 146,000 delta, and then we have negative 400,000 delta. And we can see that the CVD color is getting lighter, right? It's getting lighter, showing us that it's getting more to the negative side. And we can even see that it's coming down lower than it was over here at this low, right? We can see it's coming lower. And so what this is telling us is, yes, it technically is not a divergence, but we can see we have super high negative delta. It's 100% maxed out, super high volume, and then immediately what we have is price shooting up, trapping these shorts. And also we have now we have the CVD getting lower as the price is getting higher, trapping these shorts. So this is a key confluence we want to look at. We want to look at the volume and delta because we can catch moves that we might have otherwise missed if we were simply just looking for the divergence, right? So this right here is essentially we're looking at volume and delta to identify trapped traders, just like what we went over in the CVD session earlier in this course. And then the same is true if we are looking for a short. If we see that the let me see where that short trade was, the one that we took, the one that I took actually, not we, right here. Okay, look at this, where we had such a clear divergence. We can also see that as we're coming up to this high, look at this, we have a massive spike in volume. Okay, actually, as we come up to these highs in general, we put in our high with a massive spike in volume. CVD, delta is almost at 100%, not quite. We still have delta almost at 99%. And then look at this, we have 2.1 million volume, super high positive delta with the bearish divergence. And then boom, we come down and we trap those traders. That is another confluence to look for. The more trapped traders you can find, the better. And the way you identify how many trapped traders there are is by looking at how high the volume and the delta is. The higher the volume and the higher the delta as we're coming to that lower high and CVD is getting higher, the more traders are going to be trapped. So we're looking for that. Let's see if I can find another instance of the longs being totally out of steam. Again, when we see that 100%, that is showing us that the longs are in fact out of steam. Let me see if I could find another short. That was not technically one. Okay. This was not one either, but do you guys get the idea? You get the idea. We are looking for either the divergence or we're looking for the trap traders by looking at volume and delta, and we're looking at delta percent. And then finally, guys, another confluence I would recommend is honestly looking at Market Cipher. Because if you're looking at Market Cipher, this can give you clear confirmation. For example, the long off the VWAP today, we clearly saw the trap traders, okay? We saw the huge spike in volume. We saw the fact that we had massive negative delta and that it was maxed out at 100% negative delta right here. Right? Maxed out 100% negative delta, a massive spike in volume. We come over to Market Cipher, and what do we see as we are coming down to the VWAP earlier today? We saw bullish divergences on the 12-minute time frame as we are bouncing from the VWAP, right? This is just ultimate confirmation right here that everything we see on the order flow TR chart is absolutely happening. And look at this even on Market Cipher B on the 6-minute time frame as we're coming down to bounce off the VWAP. 6-minute uneven butt cheeks. The more confluences you can stack together, the better. The more confluences you can stack together, the better. This short up here earlier today from 39.2, we could see we had money flow and momentum coming down on Market Cipher B. If we go over to the TR chart, when we come up there, a lot of times what I like to do is I like to look at side by side. So I will like take this out. Unless you have multiple monitors, which some people do, I do not. I trade it on a laptop because of the fact that I am usually trading outside when I'm like doing work on the farm or whatever. And I literally just have them side by side like this. And I will be looking at both side by side. So up here, we actually had come to a golden pocket and a point of control with bearish divergences. So we were at a key level. We had our confirmations on Market Cipher. And let me just refresh this chart here. Let me refresh the TR chart. And let's come back in time to when that happened. That was, what price was that? 39.2. I guess we have to go back a ways for it. Here we go. This is it right here. Pretty sure. Let's see, what was that high? 39,287. Yeah, this is it right here. And so we can see up here, if we do come up, look at this. Look at this. We have massive amounts of volume coming in. We have massive amounts of volume coming in. Our delta is 99% positive. And then all of a sudden, what do we have? We have a reversal candle. And all of a sudden, we see a whole bunch of shorts coming in, right? A whole bunch of shorts coming in. And this is something that we might have missed if we were only using the TR chart. We would have thought, whoa, perhaps we're going to break out of here. But because we're already looking at Market Cipher, we're seeing the money flow coming down here. And because we're seeing delta being maxed out right here and a huge spike in volume, we know that there's the potential that a lot of traders could get stuck right here. And so we see that this candle, okay, right here, is a whole bunch of longs opening up. And then immediately we see that they are getting trapped right in here. Like literally, we see that they're getting trapped. And this brings up a really good point because this is exactly what a chicken's drinking water swing failure pattern would look like on the TR chart, where you have a massive increase in trades in one direction, right? And you're coming above a previous high. And then as soon as you close that high, you are now trapping all these traders, and then you're going to get a big move to the downside. You're not going to see the divergence every time. In fact, it's almost rare that you would see the divergence when this actually happens. But if you're looking at this and you're looking at this side by side, you can easily identify that it is a chickens drinking water type trade setup. So that is the basic introduction to a TR chart right here. We will be expounding upon this as time goes on, but in general, if you want to start winning trades right away, I would recommend you look for a wick to indicate a reversal candle and look for that CVD divergence. You are going to literally enter after the candle with the wick prints. You are going to set TP1 at $150 move, TP2 at $300 move. If it's not at a level, if it is at a level, I like to use or key levels of support or resistance. That's it, guys. I hope you found this super valuable, and I'll see y'all in the next session. Peace.